Welcome to the Regula Young Group Buyer Series. In this episode, Hannah Bassett from Ideal Mortgage Solutions joins Stacy and I to do a financial deep dive. Hi, Hannah. How are you today?
Hey, I'm good. How are you?
Good. Can you
Cool.
explain the difference between pre-approval, approval, and final funding?
So a pre-approval is a formal determination of what you can qualify for. So your income is reviewed, your credit is checked, and we discuss what you're planning to put for a down payment. And then we review those numbers and determine your gross and total debt servicing ratios against the mortgage stress test to make sure that we can see that you can afford the mortgage payments on the new potential purchase you want to make. And then so pre-qualified is when it's not reviewed. So you're just kind of plugging in some numbers and seeing maybe this will work. And then a financing approval is when you actually have an accepted offer on a house and we get you approved to buy that specific home.
Perfect.
Okay.
That's awesome.
What are lenders actually verifying during the conditional period?
So they're going to look at your income documents, your down payment, your credit. If it's going to be insured, meaning you have less than 20% down, the insurer is going to review those things as well. And then they're going to look at, they might Google your job. They might call your work to verify that you do actually work there. And yeah, sometimes they'll Google your name to make sure you're not a criminal. So yeah, they just review everything and make sure that it all works and that everything is legit.
Awesome. What are the most common issues that delay or derail financing?
Not having all your documents at a good time frame. So if you're not providing everything on time, if they've asked for extra stuff and you don't provide it, there needs to be enough time to send mortgage instructions to your lawyer so they can do their job as well. So that's one of the common ones. Or anything being misrepresented. Maybe your income doesn't jive on, your letter says you make this, but your pay stub shows that you're short. Different things like that. Large deposits in your bank account for verifying your down payment, or maybe we don't have a gift letter signed, or you got a gift letter signed and you don't have the deposit in your account yet. So we need to make sure that everything that's needed is provided, reviewed, and signed off in a timely manner.
Lots of things to think about. Yeah.
I have one thing to add to that Hannah and I have come across before, and people submit their documents like by taking a photo of them, and it's really helpful if you send a PDF. And if you don't know how to do that, ask your realtor; they will help you.
That's a good one.
Make the process a lot smoother when it's not like a sideways photo of your bank statement.
Yeah.
Just a fun fact side note that we've learned.
Yeah, that's a good one. And don't redact things. Don't black things out. We can't.
Yeah, don't change your salary because we can tell.
Make sure your name is on it.
Yeah. Mm-hmm. And like I have went to seniors' houses and helped them take photos of their ID and get everything sent in. So just have to ask for help if you need it. One of our questions that we were wondering is, when does bridge financing come into play and how does it work?
Okay. So bridge financing is sometimes referred to as interim financing as well. And it's a temporary loan. If your down payment on your new purchase is coming from your existing home, then you need to have a firm sale on that house. It has to be realtor represented. Lenders don't like doing bridge if it's a private sale. So if your down payment and your closing costs are coming from your existing house, you can get a temporary loan from your new mortgage lender for the sale proceeds that are going to be coming in. That allows you to move into the new house in a smooth way, not having to take all your stuff, live somewhere else, and then move in. So you can get your down payment and close on that new purchase before your sale closes. And then the lender, you, and the lawyer all agree that that loan is being paid from your proceeds before anything else.
Okay.
But the key is it has to be on a sale. You have to have a firm sale to get a bridge
sale with a realtor.
Yes.
Okay, that makes sense.
Yeah.
What should buyers avoid doing to protect their pre-approval and ultimately their home purchase?
Definitely don't go buy a truck. So,
or two.
Yeah, don't change your finances. So if you're getting an income increase If your credit score is going up, if you're saving more money, that's all great. Those are good changes. We don't necessarily need to know. But if your income's going down or you're going on maternity leave, which can still work, but I still need to know. If you're going from full-time to part-time, I need to know. If you're going, from one job to another job, we need to know. And if you rack up debt, that's bad. Don't take on new debt. Don't do a ton of new credit checks. Again, don't buy a car or a truck. And yes, don't do any negative changes. Don't spend your down payment. Those kinds of things make a huge impact. Negative.
Yeah, for sure. Yeah, for sure. Thank you.
Yeah, and people often think that if they don't buy something, like before they write an offer, they're fine, and then after they write the offer and it's been accepted, and then between then and possession, they're like, well, now I can buy something, and it's no, you can't.
No, wait until you're making your first mortgage payment before you buy anything else.
Yeah. Lenders can pull your credit right before you close if they want to. So
yeah.
I actually have another question that just kind of came to my mind. When it comes to like possession day, like a lot of clients will say like, oh, I don't know why they asked me this, but it's nice to have some knowledge. They're like, oh, when do I start paying for the house? Like, how long can people push like their first payment to? Like, does it have to be in the first 2 weeks, or?
It depends on their payment frequency. So if you're doing monthly, your first mortgage payment will be 1 month after your closing date. If you're doing biweekly, it should be anywhere outside of 14 days, but before the next 21 days usually. And then for weekly, it'll be sooner. So it really depends on that frequency of your payment. But when you're chatting with your broker, when you're like filling out your forms, you'll fill out your preferred first payment date and frequency.
Okay.
Yeah.
What do you recommend for people to have like for payment frequency?
It depends on what they do for their budget. So everybody's different. If you are used to, like a lot of people coming out of an apartment, for example, they're used to monthly payments. So sometimes they just want to stay that way because that's how they're familiar with their budget. If you're paid, semi-monthly, you might want to align it that way. If you're paid every 2 weeks, you might want to align it that way. So if your priority is paying off your mortgage fast as you can, then accelerated weekly or accelerated biweekly is a great way to really reduce the principal, save on interest, and pay your mortgage faster without really noticing it. But the best thing to do is align it with what's going to work for you on your budget so that you always make sure you have money in your account for that payment to come out.
Okay. Nice.
Thanks so much, Hannah. We really appreciate this. And thanks everyone for listening to our podcast or episodes. And if you found this helpful, please subscribe, like, and share. And see you in the next episode.